Hi everyone, this is Tashwita Gupta, your tutor for FR, SBR and Diploma IFRS at vifhe. So first of all, I would like to extend my warm wishes to all my subscribers. Congratulations to all of us, we all have turned 9K. Okay, so today I'm going to cover a very important topic for your March 2023 SBR exam, and I highly predict this topic. It is basically the difference between what goes into P&L and what goes into OCI. So I've already made a video of 10 minutes on this, so I guess you could be seeing the link to it. I'll also put it in the description box. So we already have an information of what goes into P&L and what goes into OCI, but I will also briefly discuss today. But the most important part of this technical article, this is technical article number 2, which is the most important one, is this part. That is income and expenses included in OCI and reclassification. Reclassification of the income, profit or losses that you have recorded in your other comprehensive income. So let us first understand that what basically this reclassification is. Okay, now you know that, for example, IAS 16 revaluation model, property, plant and equipment. The revaluation gain goes through other comprehensive income. Then when we dispose that property, plant and equipment, we make a reserve transfer, which is from the revaluation surplus, we transfer the income or the gain to retained earnings. That's the rule. That's what IAS 16 says. But that is not reclassification. That is not reclassification. Then what is this reclassification? See, there are two statements that you have. That is statement of profit and loss and statement of other comprehensive income. Now, the first and the primary statement, the most important one, is statement of profit and loss, where many, students, tutors all believe that realized gains go into the statement of profit and loss and unrealized goes into OCI. Even I have taught it in the same way in the video that I am talking about. But when I have defined the meaning of realized and unrealized there, that is different. By realized, I don't mean in cashing. I'm not saying realized means the money that you've, in your bank account. That means you actually sold. So I'm sitting here and I have a laptop in front of me. If I say the value of the laptop, which is not true, increased. So I'm not selling that laptop. So I'm not encashing that increase in fair value. But still it has happened. So many tutors believe that that is unrealized gain. But no, conceptual framework has kind of justified that what basically realized and unrealized is. So by realized, when I say realized, I mean that you have met the objective. You have met the objective. And by unrealized, I mean it is unrelated to the objective. For example, why do we have property, plant and equipment? We have it because we want to use it in our operations. We want to generate revenue. We want to produce goods, right? Now, if the value of that property, plant and equipment increases in the market, that doesn't affect my operations, does it? You'll be just happy for 2 minutes, 3 minutes that yes, the value has increased, but it is not going to affect you for more than that amount. So the objective is production. Value increases in the market, capital gain doesn't matter. So we call it unrealized and we take it to other comprehensive income. Then same way, if you talk about investment property, in investment property, your motive, your objective was to buy it for actually, capital appreciation, to get capital gains. So you invested in property, like you invest in shares, gold, cryptocurrency. Same way you invested in property, right? And when that thing happens, I was waiting for a capital gain. When that happens, I'm automatically going to say that this is realized. So I'm not calling realized, unrealized as in cashing. I'm calling realized, unrealized as what? Meeting the objective. So objective of P&L is related to operations. So anything which is related to our operations and is realized goes into statement of profit and loss. Something which is not related to operations, it's like we didn't buy it for that purpose, but it happened, it was an extra you can say add-on bonus. If that happens, for example, if I was having a factory and the value of the factory in the market increases, my factory is for production but the value increased, good, that happened for good, I'm okay with it, but it's not my ultimate objective, right? So my ultimate objective matters. Now let's move on to the fact that what the role of OCI is. So I'll be sharing this document with you. I've highlighted the important points. So what is the role of other comprehensive income? So in this technical article, they've mentioned that it is not a dumping ground. Many people believe that whatever is not important, put it in OCI because it comes after P&L. So first in an annual report you have statement of profit and loss, and then you have statement of OCI. So whatever you don't want to show in P&L, put it in OCI. Till date even ISB is confused that what is the role of OCI, why they have placed OCI. Even they are little unhappy with the fact that with the confusion which OCI has created actually, and we SBR students are also fed up of OCI, I am sure. But just try to understand the reason why ISB created OCI little bit. Just try to understand with your logic. So it's not a dumping ground. We put unrealized gains there. By unrealized, I don't mean the general unrealized which everyone says in cashing. By unrealized, I mean non-operating, non-objective meeting. So that is put into the other comprehensive income, and every IFRS will state that. Now automatically if there is an income and gain, we say it goes into statement of profit and loss, but only a standard can tell us what will go into OCI, because OCI is a new thing, unique thing, rare thing. So we cannot say automatically this goes into OCI. Automatically every income and expense goes into P&L, but few exceptional items goes into OCI, and it is mentioned in every standard. For example, revaluation gain goes through OCI, then your revaluation gain on IAS 16 and IAS 38 also goes in OCI. Then you have IFRS 9, some equity instruments are held under fair value through OCI. Then you have your debt instruments held under fair value through OCI. So you have many such things which goes to other comprehensive income. So let's come back to what reclassification is. So they say that reclassification is also referred to as recycling. I said reserve transfer from revaluation surplus to retained earning is not reclassification. Not reclassification, okay? Many students have this confusion. Then what is reclassification? Reclassification is, see, something which was recorded in OCI would have automatically gone to your other components of equity. Like every year end, what is the journal entry that you pass? You transfer the gains recorded in the P&L to retained earnings. From your accounting equation, you know that profit for the year gets added to the capital, loss for the year gets deducted from the capital, right? Same way, OCI goes into other components of equity in your balance sheet, that is statement of financial position. So if there is a reserve transfer between OCE and retained earning, that doesn't matter. We are not talking about it. But we are talking about if something is transferred, it was in OCE, then it also again in the future period went to P&L. What do I mean by this? First, I took that gain through other comprehensive income. Let's talk about IAS 21 retranslation reserve. The forex gain or retranslation gain that you make when you have a foreign subsidiary. IAS 21 I'm talking about. So there your retranslation reserve is kept under other comprehensive income. All of you remember IAS 21? It goes through OCI. If it went through OCI, it must have gone to other components of equity. It's there in other components of equity as retranslation reserve. But when I will dispose that subsidiary, when I will dispose that foreign subsidiary, what I will do is, after my all the calculations, profit and loss on disposal of subsidiary, After that, I will reclassify. I will take out that retranslation reserve. My journal entry will be retranslation reserve debit, and my statement of profit and loss credit. So when that retranslation reserve was created, OCI was credited. Now I'm transferring it from the reserve to the P&L. So 2 times. Now automatically at the year end, whatever went to P&L will be taken to retained earnings. So you must be thinking, ma'am, it is affecting our income statement 2 times. Back when I was the owner of the subsidiary, then also I took the gain through OCI, but it was taken to income statement. OCI is part of income statement. So it was taken to income statement in the OCI. Then when it was disposed, again for the sake of reclassification, you took it to this year's statement of profit and loss. So you recorded a profit of 2 times. Yes. Unfortunately or fortunately, yes. So it will go 2 times. First of all, it will be going to OCI. Then upon its disposal, it will again go to statement of profit and loss. So that's why we call it recycling, using it twice. Recycling, using it twice in the income statement. So now I hope you understand, I'm not talking about a mere reserve transfer. I am talking about a bigger thing, that is reclassification. Okay, so this is a very important topic, guys. I mean, it was asked in your pre-March 2023 mock, SBR mock. I will show you the question once we are done with it. So make sure that you listen to it very attentively. So that's what reclassification is. So let's read it a little ahead. Okay. See, read it with me. Statement of profit and loss and OCI is designed to be useful to a broad range of users. In particular, users will often attempt to assess the future net cash inflows of an entity from this statement, which should be understandable and comparable. Now, people like us who are investing in a company, they will use income statement, that is P&L, and OCI for the sake of understanding that what can be the future of this company, right? That's what this line is saying. An entity can choose to present a single statement of profit and loss and OCI, or may present statement of profit and loss and OCI separately. OCI now separately those items which may be reclassified to P&L and those items which may not be reclassified. So whatever gain and loss you put in other comprehensive income, you have to mention, will it be in future reclassified to P&L or will it not be reclassified to P&L? So let me give you a quick list of what will be reclassified and what will not be reclassified. So that is the most important thing. So here is your list. Let's have a look at this. So the items that will not be reclassified, the revaluation gain. The revaluation gain which went through OCI will not be transferred to P&L any time in future. It will not be transferred. It will remain in OCI. Later on, when we dispose that asset, we will do a reserve transfer. Reserve transfer is nothing, like it's not recycling, you know. It's just like something was already there in that balance sheet and it is a balance sheet to balance sheet transaction. Reserve to reserve transaction. Recycling is when we take something again to the income statement, right? So revaluation gain is not reclassified. IS 38 revaluation gain, again which went to OCI, remains in OCI. Reserve transfer will happen, but it will not be reclassified to statement of profit and loss. IS 19, what do you have in IS 19? Defined benefit pension scheme. In that defined benefit pension scheme, you have your remeasurement component. Just a quick tip, always make sure you know why this remeasurement component arises. Again, that's a very important direct question. Why does remeasurement component arises? because there are some assumptions which the actuary takes and the accountant doesn't take, right? So remeasurement component also goes through other comprehensive income, and it is never reclassified to statement of profit and loss. If you ask the logic for it, you read this technical article, you will understand that IASB itself says that, you know, we don't have a proper basis, but we just talk about two words, two very famous words. Whenever you don't find any logic, just say that whatever give us relevant and faithful representation, we do that. So even IASB has no basis of saying that why what is reclassified and why what is not reclassified. So it's a rule based approach, it's not a principle based approach, right? So remeasurement component not reclassified. Then your IFRS 9 financial instruments, the equity instruments, your financial assets which are kept under fair value through OCI. Your equity instruments can be kept under two subsequent methods. One is fair value through P&L, another is fair value through OCI. When do we keep it under fair value through OCI? When it must not be held for trading and we made an irrevocable choice upon designation. When I say irrevocable choice, that means, for example, a child was born and, you know, the parent came, the grandfather came and said he will become doctor or he will become an engineer. So he kind of made an irrevocable choice. He made that perception, right? So that's what that movie 3 Idiots was based upon, if you guys know, right? So if you have made an irrevocable choice, then that is to be kept under fair value through OCI. But this gain or loss is never reclassified to statement of profit and loss in future. Then the fair value change of a liability, of a financial liability. Now for this, I will just revise the concept of financial liability with you. Financial liability, if you remember, has two methods. In FR, you studied that it just have one subsequent measurement, that is amortized cost. But actually, it has two methods in SBR, which is the actual scenario. One is amortized cost, another is fair value through P&L. When do we keep the liability under fair value through P&L? Either that liability is held for trading, like derivatives, you know that a derivative might be a financial asset or a financial liability, right? So even the liabilities are in trading, or you are keeping that liability to what? To avoid accounting mismatch. So let me discuss another aspect of this technical article with you, the meaning of this accounting mismatch. So accounting mismatch means, for example, investment property is there under IS 40. So you bought an investment property and you keep it under fair value model. So you are taking the gain and losses through statement of profit and loss. But let's suppose to finance this purchase, you took a loan, and that loan, if it is kept at amortized cost, they say this loan and this investment property are economically related. Why? See, if we say two people were born together, twins, right? So they become related from their birth. So if two accounts were, you know, coming into the ledger or the journal together, they become economically related. Their journal entry was passed together. So in this case, the property which we bought, property debit and the loan was credited, right? Now that property is being kept at fair value through P&L, but that loan is being kept at amortized cost. So they say this is an accounting mismatch, and only some companies feel so. Again, this is a company to company thing. It's not a hard and fast rule. So some companies who feel this accounting mismatch, they will say that because our property is at fair value through P&L, let's keep our liability, that is the loan that we took to finance that property, also at fair value through P&L, right? So now you know that in financial liabilities, we also have a new method, that is fair value through P&L. But they say in this case, when you are keeping that loan under fair value through P&L method, when you are keeping this loan under fair value through P&L method, then you have to identify what is that fair value change which happened because of its own credit risk. What is credit risk? risk of non-repayment. That means the counterparty. So for example, okay, if I am owing you something, so for me it's my liability. So credit risk is maybe I lose my job, maybe I am not able to repay because of any financial difficulties. So in that case, I call it as credit risk. So the fair value of the liability changes due to many factors, external factors and the factors like credit risk. So whatever is the change in fair value because of credit risk, it goes through OCI. In this method, I'm talking about fair value through P&L method only. It goes through OCI, and whatever is the change due to other factors apart from credit risk, that is taken to profit and loss. So they say this particular change in fair value which went through OCI for a financial liability which was kept under fair value through P&L will never be reclassified to statement of profit and loss. Confusing, right? Just pay a little attention, read it from the paragraph I'm going to highlight, and you will get it. So I just explained you can again just listen to whatever I just explained, turn the caption on and understand what I'm saying. Okay, that there is a financial liability whose change in fair value is going to P&L, but we divide the change in fair value. What is the change due to the credit risk? What is the change due to other factors? The change due to credit risk goes through OCI, and that change is never reclassified to statement of profit and loss in future. Okay. So these are the list of items which are not reclassified to statement of profit and loss. Then ma'am, what is reclassified to statement of profit and loss? This is a huge list of what is not reclassified. So let us understand what is reclassified. So first of all, IFRS 9, effective portion of the gain or loss of a cash flow hedge. Now if you want, I can make a proper video on hedging, even though my paid students, you have a proper lecture on it. But if you want to, let me know if you want the hedging lecture or not. It is a technical topic but not a difficult one. Sorry, I said it wrong. It is a difficult topic, technical topic, but not so important one, right? So cash flow hedge, we are talking about what is hedging? Risking, creating a hedge against the risks that we have. So, for example, if I have to make a payment to my foreign university, I know that this payment has to be made maybe after 6 months, 1 year. So, in that particular case, what I do is, today only I will assess my risk, that if the exchange rate changes, I'll have to make a different payment. So, I'm going to make a cash flow payment. The cash is going to go out of my bank account, so it's a cash flow. So I need to hedge that risk, that maybe today the exchange rate is good, tomorrow it might be adverse, so I'll have to pay more. So for that I get into hedging, where I buy such a derivative. I bet against my fear. My fear is that the exchange rate will change unfavorably, so I will bet in such a derivative which will help me to make a gain. If that exchange rate changes unfavorably, I will still make a gain on that derivative. So if with the unfavorable change, I will create a loss on my cash flow, I will make a gain on that derivative. So it's an inverse relation. So if you want, we can make a video on that. So that is basically cash flow hedge. Then in cash flow hedge, we say that the things goes through OCI. The fair value changes in that hedging instrument and item, that goes through other comprehensive income. So that after you de-recognize your hedge, that is reclassified to statement of profit and loss. So the effective portion of your cash flow hedge, when you de-recognize it, goes to statement of profit and loss, right? Then again, you can just know this like by word. You can just learn this one. I think hedging is not that important, but if you want, we can talk about it just in case you have problem with it, and if you have not done this from your tutor or anything. Then IAS 21, this is very easy, I just talked about. IAS 21, if you have a foreign subsidiary, you must be having your retranslation reserve. Now that retranslation reserve is actually transferred from your statement of other comprehensive income to statement of profit and loss when we derecognize that subsidiary. So that is a comprehensive list of what is reclassified and what is not reclassified. From where can you read this, whatever I just taught? I will highlight that paragraph for you. I explained you the treatment and I gave you the list. Here they have just given the list. So you can actually read it over here. This one. See this paragraph, list of what is reclassified and what is not reclassified. Now what actually is very important is arguments for and against reclassification. So this is something which is asked in your SBR pre-mock. Now this pre-mock is very important thing. It is already available on your portal, pre-mock March 23. You can actually attempt this. It's, I have this experience. Whatever they ask in the pre-mock, up to certain extent, whatever they ask in the exam is quite same. Not the exact question, but at least the topics. So this is there in your pre-mock, and that's the reason why I'm saying again and again, it is very important for you to know this topic. Let me show you that question in fact. Okay, here you see this question. Discuss with examples the nature of a reclassification adjustment. Nature means you will talk about what reclassification is, what is reclassified and what is not reclassified. The arguments for and against allowing reclassification of items to profit and loss. You should refer to the conceptual framework in your discussion. Conceptual framework, 2 words, whatever is relevant and faithful representation. You are not required to refer to any of the exhibit. 6 direct marks. So let's pray this one comes up so that you can answer. You've been given an exhaustive list of what is reclassified, what is not. So if you are going to be lucky, this is going to actually come up. So arguments for and against, let's understand. We'll read it line by line. There are arguments for and against reclassification. If reclassification ceased, that means if there was no reclassification, then there would be no need to define profit or loss or any other total or subtotal in profit or loss, and any presentation decisions could be left to specific IFRS standards. So what they are trying to say here, that if we stop reclassifying, that means taking the gain or the loss which was recorded in OCI to P&L in future years, then there would actually be no need there will be no importance of the profit and loss, because what went to OCI got dumped in OCI. So they say that would be always left to IFRS standard what goes into OCI. But sometimes for the time being, like our logic for the time being says that it's an unrealized gain, so let's take it to OCI. But maybe in future it becomes realized, so you should record it in P&L. So if we don't do the reclassification, then P&L will lose its importance. That's the gist. It is argued that reclassification protects the integrity of the statement of profit and loss and provide users with relevant information about a transaction that occurred in the period. So basically they are talking about importance of statement of profit and loss. So if for example there is a very high profile person in your let's suppose in your house, he just came to visit you and you guys don't pay attention to him, he will feel ignored, he will feel like I'm not important to them. Same way this statement of profit and loss is a VVIP. If you do not reclassify, if you don't give him that importance, then he will feel neglected, it will lose its integrity. So now by doing this reclassification, understand what we are doing. We are saying OCI is less important. That's why we are taking things from OCI to P&L, right? That okay, for some time OCI can keep that gain with it, but ultimate parent of that gain is P&L. So basically we are saying P&L is more important, right? He is the actual hire of gains and losses. OCI was just like a temporary holder of it. So additionally, it can improve comparability, where IFRS standard permits similar items to be recognized in either profit or loss or OCI. So it will just increase comparability. That's one thing they've said. So two things here: to maintain the statement of profit and loss importance, we do reclassification, plus to increase the comparability. These are the four advantages of reclassification: importance plus comparability. No need to explain it. Then arguments against reclassification include that reclassified amounts add to the complexity. We have so many disadvantages. I'm sure you guys can also list so many disadvantages, that it is very complex, very difficult, and there is no logic to it, right? So that's what they're saying. Complexity is there. Then this can lead to manipulation of account earning management. If there is no proper logic that why you're reclassifying, that an accountant can misuse it, right? That I want to increase my profit in some year, so what I did, I reclassified something from OCI to P&L. So I increased my profit. The reclassification adjustments may not meet the definitions of income or expense, because what is income and expense? That is what occurred in that period, but what you are reclassifying is not income or expense of that period, right? So it was occurred in previous period. That's what I said. There was a gain on there was a gain on remeasurement. That means there was a gain on retranslation of a foreign currency or a foreign subsidiary. You kept it in OCI. Then after 5 years, you're saying let's take it to P&L. Now that thing it didn't happen. That gain that you're taking from OCI to P&L, that happened few years ago. It is not that current year's gain. So that's what they are saying here, that it doesn't meet the definition of income or expense. Then the original logic of OCI was that it kept income relevant items that possessed low reliability from contaminating the earnings number. Again, they don't use good words for OCI. So they are saying that OCI was like lesser important. We didn't want to contaminate statement of profit and loss. So less important things were put in OCI. That's what I said, not meeting the objective, unrealized. So markets rely on profit or loss, and it is widely used. The OCI's figure is crucial because it can distort common valuation techniques used by investors. For example, OCI is going to be part of your other components of equity, so it will increase your equity. If it increases your equity, it will increase your return on equity. It will affect your price earnings ratio. So they are saying that thus profit or loss needs to contain all information relevant to investors. Misuse of OCI would undermine the credibility of net income. So they started the disadvantages by saying complex, then manipulation, it doesn't meet the definition of income and expense. Then they further explain manipulation, that if what is less relevant is put into OCI, then accountant then further takes it to the P&L, then it will also affect our key performance indicators. So these are the 3 or 4 disadvantages and 2 advantages. So now you understand what reclassification is. You know the list, you know the advantages and the disadvantages. These 4 things are very important for your exam. Make sure you understand them. Then they have accounting mismatch. I just explained the accounting mismatch to you. No need to read this one. This example is a bit exhaustive. No need to read this. I gave you a very cute little example about investment property IS 40, right? That when you take a loan against investment property, then loan is kept at amortized cost, but the investment property is kept at fair value through P&L. So that is an accounting mismatch. So this is it about this technical article. I hope you understood it. It's a very, very important technical article. I'm going to share this file with you in the description box. Make sure you read this once. As I told you, it's important. Now the next technical article that I'm going to cover is going to be the crowdfunding plus the sustainable reporting in one video only. So till then, you can watch the current issues video which is there, and in that current issues video we have covered natural disaster cryptocurrency. That is also two of your technical articles, right? So natural disasters and cryptocurrency we've already covered in current issues. This technical article was not covered, which I've covered today, and I request you to wait for a day for the new video on your crowdfunding plus sustainability reporting. Again, very two important technical articles. So I hope you liked this video. If you did, please do like, share, subscribe and comment. And all the best for your preparation. I hope everything is going fine on your end. Thank you so much for watching the video.